Hello and welcome. Today, we're going to be talking about how does a mortgage work exactly? If you're new here, my name is Taylor Darcy from Think Legal, where I help businesses and people thrive. So welcome. So happy you joined me. If you're catching this on the replay, please know that we go live Monday through Friday at 11. We're going to be bringing you lots more value. Lots of things are going to be changing. We're going to be building this. It's going to be bigger and better. So please tune in or, make sure to watch the videos. Let's get started, shall we? All right, so you've been thinking about buying a house, but you're really not sure about what exactly it is you're going to get yourself into. In this video, we're going to break down what a mortgage is, how it works, and some things to look out for. Now, keep in mind, in a different life, I was actually a loan officer, so I have not only legal firsthand knowledge on this, but I also used to write, or not underwrite, but I used to do these types of loans. This is what this was part of my career way back when I worked for banks and credit unions and stuff like that. So these tips are going to come from what I knew, but also based on what I know. So this is going to be fun. All right. So what exactly is a mortgage? Well, the correct version of that is that a mortgage is a loan. Okay. It's a very big loan, to be an understatement. It is a loan to purchase a property. Now, the home is used for collateral. What is collateral? Collateral is the item that the loan is based on, okay? So, for instance, a car could be considered collateral. In some instances, a ring, if you're selling a ring, or if you're trying to buy a ring, you could have that set as collateral so that if for some reason you don't make a payment, that they can come take your ring to then sell to make the payments for the loan. So the house is the same thing. It's collateral for the loan that they're giving you. So if you take a loan out and then you don't pay it back, they can then do what's called a foreclosure, okay? When they foreclose on the home, that's it. It's their home again. They lend you the money, you didn't pay it. Now you have to worry about having a foreclosure. Now, we're not going to get into the dirt on this one, so don't feel like this isn't going to be the 102. This is more like 101 or 100 level language. So please, we're not going to talk about short sales. We're not going to talk about some credit default swaps, things that caused the financial meltdown back in 2008, 2009. We're not going to talk about that. The reason why is because I don't want to muddy the water with things that, for right this minute, are not relevant. Okay. So a mortgage is a lien on the property. What does that mean? You can't sell the property without paying off the lien. Now, you can have a first mortgage, a second mortgage, technically even a third mortgage, and then you can have all sorts of different liens in between. And what happens is that your value of your property has to be able to support that lien. What does that mean? So a first mortgage is almost always supported. That means they're in first position on the mortgage. And that means that your value, if you were to sell your home, would take care of that first mortgage. Now, sometimes that first mortgage is less than the value of your home, which means you would have what is considered equity in the home. If your mortgage is more than the value of the home, then you do not have equity in the home, and you're considered what is called underwater, essentially. Okay. Now, that means that if you were to sell the home with there would need to be a difference paid, right? Like if your home is only worth, $500,000, but the mortgage on it is worth $700,000, and I'm just using that for instance. These aren't real numbers. Then you would owe that $200,000 because you bought a home that isn't worth what it is the mortgage is. It's just like a car. It's also called upside down, in case you were wondering. So if you're upside down on a mortgage, that means you owe more than what the home is worth, which is a whole different issue. Again, we're not going to muddy into the water. We're just talking about this. So in other words, a lien gets placed on the property and needs to be paid off if you ever sell. If you never sell, then that lien doesn't go anywhere until you've paid off the mortgage. If you pay off the mortgage, you have no lien on the property, and the property is yours. You own the property free and clear. Same thing goes for a car, right? If you pay off a loan on a car, you own the car free and clear. Title's yours. You can do whatever you want with that car. Okay. So the reason why this is important is because you could have a first, a second mortgage. You can also have what's called a home equity line of credit, which is a revolving line of credit that you can use at your discretion to pay for things relative to the home. A home equity line of credit is often used to make home improvements that, for instance, you'll pay down and then pay more back, and then you'll use it more to make more home improvements, and then so on and so forth. And then what happens is, after you've done a home equity line of credit, you then can, some lenders will allow you to refinance into a second, right? That will then the payment becomes fixed. You don't have the variable rate, and you don't have the revolving aspect of a second. That's really good if you're wanting to get that paid off, and also at that point, because you've done these home improvements on the home, there is additional value in the home, and so you can show that through an appraisal that then gives you more equity, right, if you're going to do it. So you can improve the value of your home by using a home equity line of credit properly. Okay, so that's a first, a second, and a home equity line of credit. Those are very similar things. Now, what exactly is it? So when you sign for a loan, you then are signing what's called a promissory note, which is the simple version of it is you're promising to pay. People will call it, you'll hear it be called the note, okay? Hold the note on your home. And now there are requirements that each promissory note is required to have by law to make sure they are complying with lending requirements of homes. Number one is interest rate. How much is the money going to cost you? Okay. Now, this is something that a lot of people get wrong, and you need to be better than that. Okay. So here's what's wrong. The interest rate that they charge you is the interest that they're expecting to get, but also based on the creditworthiness of the borrower. The worse credit you have, the higher your interest rate. Why? Because it's a bigger risk for them. They want more money because of the risk that it is associated with lending you money. Okay? So the reason why that's important is while you get your credit in order, your payment history, all sorts of things, your down payment, you have to keep in mind that the interest rate is their risk, not yours. Obviously, everybody wants a lower payment. And obviously, a lower payment is better for you because it's easier to make. The problem is that's not the way they're looking at it. They're looking at it from the perspective as, if you don't pay me off because you're a higher risk, how do I get my money? That's all they care about. The bank, the lender, the mortgage, all they care about is how they get their money back. That's it. There is no like, oh, I want to do the right thing. I want to give people homes. That's not what they're thinking at all. They're thinking, how do they get their money back? So they'll charge you more money because they're worried about getting their money over the long term, which is why a lot of people will start out with a higher interest rate and then also refinance at a later point after they've made successive payments over time. They've gotten the equity up. They've made some adjustments on things. And it's helped them move that rate. It's helped reduce the lender's risk. Okay. So that is the promissory note, interest rate. They have to also disclose how much is the total loan amount. Now, the total loan amount is based upon the amount. If you make all the payments on time, you have no late penalties, and you never refinance, and it's as though the loan stays in that exact spot forever. Okay, so that's your total loan amount. It has to be disclosed. How much will you pay in interest? How much will you pay in principal over that period of time? The next thing is the term. Now, there are a lot of variations in the term. What do I mean by that? So The standard 30-year fixed mortgage is very common. They also have a 15-year fix. They also have variable rate mortgages. They have balloon mortgages. They have lots of different options to fit lots of different budgets, okay? What's right for you? Again, I can't answer that, but always go, in my opinion, it's always best to be the most conservative. What is your worst case scenario, not your best? The people that get themselves in trouble with lending are the people that go with their best case scenario, and then the worst case scenario happens, and then they're screwed. So go with your worst case scenario of what your finances are, everything, and we'll talk about that in a sec. And you'll be much happier than if you try to go with your best case scenario and then stuff happens, as is very often. So I generally, when I was a loan officer, I recommended 30-year and 15-year fix because it was the most conservative numbers that you weren't going to be out your home if things changed. If you can't afford a 30-year or 15-year fixed because you need that variable rate or you need those balloon loan, whatever it is, you add additional, it's good for the lender, it's bad for you. You're adding additional risk to your purchase, okay? So you want to be very, very careful on those. Like, don't do them. You don't want to risk your home because you were trying to get too big of a home for what you could afford simply to get because you got a better rate in that instance. Think of worst case scenario. You're going to have a property for 15 to 30 years, right? So there's recessions that can happen. There's unemployment that can happen. There's lots of different options, things that can happen. Do yourself a favor. Don't make your mortgage one of them, okay? Don't make that mistake that a lot of people made in 2000 and up, okay? So the term, when is the loan considered late? This is an important detail. Not a lot of people pay attention to it. They just sign what they're going to sign. They will specifically say when your loan is late. So you have a 10-day grace period. You have a 4-day grace period. It's due on the 1st, but you have until the 4th. When are things late? That you need to pay attention to that. And then you have to see where it is broken up from a monthly principal and interest payment. So what will that be? And there's usually an amortization schedule that goes with most promissory notes that shows you, okay, for the first month, and I'm not even kidding you on this, your first month's payment will 95 to 99% of it will go towards your interest because of how big the loan is. And then as you whittle it down, as you continue to make payments over time, you can save substantial amounts of money by paying extra, okay? Pay an extra $100 that only goes towards principal. If you're only paying $100 the first month in interest or principal anyway, that extra $100 that goes towards principal is going to make a big difference over the long term. So if you can, make sure you're getting the right, checking your loan to make sure that you're having the right types of terms on it. Most loans, not all, but most are what are called simple interest loans, which means they only get charged interest based upon the outstanding balance. There are other types of loans. Not going to touch those today because, well, they don't matter for most people. Okay, so that's it. There are also something called what's called a deed of trust. It's like a mortgage, except for there's 3 parties instead of 2. In a mortgage, it's 2 parties. It's a party, it's the lender and the borrower, okay? Or the mortgagor and the mortgagee, if you want to get all legal, technical stuff on it. So with the deed of trust, what happens is that there's 3 parties. There's a trustee that holds the deed in trust so that if you don't pay, they can then come and sell your property. Depends on your state, depends on your location. Mortgage is just what most people consider normal, and it just depends on your state and jurisdiction. So please check with the local attorney or a local mortgage broker or real estate agent. Okay. The next thing, and this is one of those ones that a lot of people forget about when they're looking at home prices, is mortgage closing costs. They're charged by the lender. They include the appraisal, title fees, title insurance, surveys, recording fees, and many more. They're usually a percentage of the property amount. Do not forget that. So when you're looking at a home, you need to factor that in. Either it's got to come out of your down payment, or if it gets stacked into the loan, it's going to increase your loan. And that's going to be something you're going to be paying interest on over time. A lot of people don't think about that. How much is that money actually going to cost you? Depends. Okay, so, but you got to consider that. Like it can be 1%, 2%. It depends on the loan, depends on the lender, depends on that sort of thing. But just be aware of them. This is what I'm saying. A lot of people get into lending, start looking at homes, very doughy-eyed and thinking everything's going to be great, and then they end up regretting it later because it gets way more expensive than they were expecting. Now, to be fair, most everything's that way. It's very frequent that things are more expensive than you think they'll be, not because it's just because you can't know everything that happens. So be careful with that is all I'm saying. Be careful about your mortgage closing costs. Some of that's open to negotiation and some of it's not. It just depends on your mortgage. It depends on what you're doing with it. Some of them are set, some of them are percentages. So just be careful. Also, if you're buying a house or selling a house, you have your realtor, which isn't just a matter of someone showing property. That's not what they do. That's not just what they do. They're paying attention to the market. They're giving you advice. They're preparing the home. There's so many things there. They are worth their weight in gold because they know the laws surrounding buying homes in your jurisdiction. And you really want to have as many, when you're making a very expensive purchase, you really want to have advocates on your side that are going to help you make the right decision because the other side has a vested interest in giving you the rose-colored glasses approach, right? Like they want to sell their property for as high as humanly possible. You want to buy a property for as low as humanly possible. Well, in the mix of all of that, having a good, not only your mortgage lender, your realtor, your attorney, if you so inclined, all of those things, we review these documents, make sure that there's not improper liens on property, make sure that you're protected, make sure the surveys come back correctly, make sure the appraisals are done. These types of things will give you the confidence that spending a large amount of money will give you if you take them seriously. People that don't do their due diligence and just want to get something done are the ones that bad things happen to. I'll be honest with you. I find that true in everything I do. People that get stuff reviewed don't. People that have a realtor and have a good lender, all of these parties are going to be on your side to help you get the best home possible. So the next thing, and this is one of those ones that is I don't say least understood, but it's perhaps the least known about for people that haven't bought a home yet. What are considered discount points? Okay, a discount point is money that you pay the lender in advance, like as part of the closing process, to buy down your interest rate. Okay, why is that important? Remember when I talked earlier about risk? You're helping alleviate the lender's risk factor, right? You're reducing that risk to a different amount, right? Like if they're 1% or 2%, which is called 1.2 points, whatever it is that you're paying extra, says I'm paying this to the lender and then I'm helping them feel more comfortable with me being in the property, okay? Because I've given them an additional reason to lend to me, right? Their risk is reduced by me buying these discount points, okay? They're called points. Now, back in the housing crisis era, I had guys that wanted to charge 2 points on the front. We'll talk about mortgage insurance in a minute, William. In the lending back then, they would charge like 2 points on the back end and 2 points on the front end to get people into homes. So you're talking 4 points on things. It gets expensive quick if you're not careful. And sometimes that's done to the loan officer and sometimes that's done to the lender. So you got to be really careful and read everything that you do. Also, be careful of prepayment penalties. This is one of those ones that can get you, can really hurt you. Like, especially when the market is kind of volatile like it's been recently. If there's a prepayment penalty on your mortgage, then it's going to cost you more money to refinance. And the idea being that The idea being that if you're paying all of this money, you want to get the maximum rate possible. And that's where the prepayment penalty comes from, is that the lender is like, well, we want to get all of our money possible. If you're not going to continue the loan with us, then we want some portion of that money that we would have got. So you got to be careful about what is on there, like as far as if there's a prepayment penalty, because although there might be great rates going, you might not see the benefit of doing a refinance if there's a prepayment penalty on there. Okay. So last but certainly not least, mortgage insurance. This is what William was just talking about. What's the difference between FHA or conventional PMI? Private mortgage insurance is what he's talking about. And so I didn't deal with FHA loans when I only did conventional lending. So FHA is a different program entirely. I only know it tangentially. Okay, I will explain the best I know of it, but you definitely want to talk to someone who has worked with FHA loans. But I can tell you about private mortgage insurance. Private mortgage insurance is money that you pay as the borrower so that the lender is made whole if you default. It's one of the biggest rackets I've ever seen. You're paying money, insurance, so that the lender is made whole. Not you. Doesn't give you anything. Okay? That's what's mortgage insurance is for. Now, that being said, that's typically why a first mortgage should be no more than 80% loan to value. Okay? So remember earlier when I talked about upside down versus having equity, that's what I'm talking about. If you are, say we're just using $1 million as a nice, easy number to talk about, okay? If you have borrowed more than $800,000, okay, so your home is worth $1 million, but you've borrowed $800,000, you're okay. You do not require, the lenders will not require private mortgage insurance. There are some exceptions to that, but we'll just say with the loan to value that you're at. However, if you're at $85,000 or $850,000, then you would have private mortgage insurance. Okay, and again, this is money that you're paying, private mortgage insurance, to make the lender whole if you default. And this is typically done by newer buyers. It's common, but that's why it's so important that you can get that 20% equity as soon as humanly possible so that you stop paying that PMI that you otherwise would be paying. Now, William asks, how soon can you get it removed? That's a great question. You can get it removed as soon as the loan to value reaches 80% or lower. So for instance, if your house appreciates in value, you can get it removed because you just have to do an appraisal. And then sometimes they'll just do a loan modification that takes the PMI off of it. Sometimes you have to do a refinance. It depends on the lender. So you have to be careful, though, on those instances. You have to watch out for it. Other times, you have to pay it down. So the more you pay into that loan, remember I said that extra $100, the market conditions fluctuate, right, goes up. You're paying that extra $100, you're getting that 80% loan to value or less, and you're able to get that PMI taken off. But again, this is between you and the lender because they're the ones that require it, and it's an extra expense, okay? Which is why it's so important that you pay attention to these details, because in the end, what you don't want to do is, like, you started out looking at this beautiful home that costs this, and then you end up not being able to get that home because of all of these extra things. There's lots of ways to make this happen. Get a better down payment. You can also take out you can do what's called we did in lending where I used to work, we did what's called an 80-10-10 loan. So instead of 20% down, there was 80% in a first, 10% in a second, and then 10% down rather than the 20% down. And that was the best because it's not about the second, it's about that first. As long as your first is 80% loan to value or less, then you don't have to worry about the PMI most of the time, okay? Doesn't mean all the time. Sometimes lenders will be jerks and require PMI on things simply because they can, not because they should, okay? So it just, you really have to pay attention to these details. So it might be worth going with a different lender if that's the case. And it might also make more sense to go to a different lender too if you can get a better rate. I mean, everybody wants to get a better rate, but you got to be careful because sometimes better rates equal more terms that are the same. Also, PMI is typically not tax deductible that I'm aware of. If there's a CPA watching this, feel free to correct me. Versus interest is typically. Okay. Again, this is a CPA question. Tangentially, I'm discussing what it is that's important to know. But the specifics of your situation is important that you review with a mortgage lender, a realtor, an attorney, anybody in your local area, a CPA that has your financial history in mind, any of these types of things that will help you make the right decision for your situation, okay? That's what's most important. William, I hope you were able to get the answer you're looking for. Feel free to leave a comment below if I didn't answer it enough. I'm happy to answer it after the fact. If you've gotten value out of this video, thank you for joining me. It looks like I had a few people on there. If you've gotten value out of this video, don't forget to subscribe and like. And know we go live Monday through Friday, except for, you know, life happens occasionally. So, hey, thank you so much. Have a great day. Oh, yeah, don't forget to that bell icon so you're notified. That just works better.